Learning Objective 17-4 is to understand and explain basic concepts for financial reporting in governmental accounting. And again, our idea here is that the purpose of governmental accounting is very different from commercial accounting. Commercial accounting is concerned with measuring profits, also measuring financial position, whereas governmental accounting is very concerned with accountability and making sure that money is spent the way it's supposed to be spent. So financial reporting breaks down governmental units according to what's called a primary government, breaks that into component units, and what's called other organizations. So the primary government would be just the core government and the basic things that the government does. And then sometimes there's what's called component units, and these would be legally separate organizations where the primary unit has financial accountability to the government. And then there's what's called other organizations, which have a significant relationship with the primary government and should be included in the financial statements. So the problem is that governments tend to create organizations and do all these different things all over the place. And what we want to make sure is we want to make sure that the financial statements include everything that the government is responsible for. So if the government controls a not-for-profit organization and funds it and is responsible for its debts, then that's really part of the government and it should be consolidated with the whole rest of the government. So governments don't just consist of all these different funds. Sometimes they consist of these other organizations that need to be consolidated with them. So GASB 14 came out to say that financial accounting exists for all these component units in a situation where the primary government appoints a majority of the governing body and either it's able to impose its will on the organization or it gets a financial benefit or assumes a financial burden for the organization. So, first of all, a majority of the governing body comes from your government, and then your government can impose its will on the organization, which it probably can if a majority of the organization's governing body was appointed by you. Or it gets some kind of financial benefit or assumes some kind of burden if you're responsible for their liabilities or if you fund their activities, then they become part of the government itself. And this assures that when we're consolidating all of the different pieces of the state or local government that are really part of it. GASB 34 established what's called the Governmental Financial Reporting Model. And this was based on FASB financial accounting. And it created two sets of financial statements. One is called the fund-based financial statements, which is focused on accountability. And this is very much based on what traditional governmental accounting looked like. And then it created this entirely new category called government-wide financial statements. And this was a GASB innovation. And what this is a consolidation. It's not quite a consolidation. You'll see later on. It's kind of consolidating worksheet. But it's a consolidation of all of the governmental entities into a single set of financial statements, like a balance sheet, like an income statement, like a statement of cash flows, that establishes accountability for the entire unit. And this is something that's relatively new, and it should include everything. So governmental reporting involves really two sets of financial statements, what's called the fund-based financial statements, and then this wild government-wide financial statements that the GASB invented. So for governmental funds, you're going to have a balance sheet, statement of revenues, expenditures, and changes in fund balance. And when you're recording funds, this is based on the fund-based financial statements. You're going to use the current financial resources measurement focus, meaning that if financial resources are not current. In other words, they don't have an immediate impact. Assets are not expendable, or liabilities are not due within a certain amount of time. Then those are not relevant to your fund. So long-term investments don't go into a general fund. So this is what the balance sheet for a governmental fund is going to look like. It's going to be based on this current financial resources measurement focus, and then it's only going to include financial assets used as cash or other assets that will convert into cash in the normal course of operations over the near future. That's your assets. That's it. So there's no long-term assets there at all. Equipment does not go on the balance sheet of a governmental fund. It says it right here. Long-term capital items are not reported on the fund-based balance sheet, but they do go into the government-wide financial statements. Same thing with liabilities. You only report liabilities that have become due or require current financial resources to liquidate. What this excludes is, it excludes long-term debt principal that's not due within the next year. And again, government-wide financial statements will include this, but a governmental fund's balance sheet does not. And the way to summarize this all very nicely is it's just current assets and current liabilities. So the net fund balance would be the difference between these assets and these liabilities, ignoring long-term assets and long-term debt principal. And what GASB 54 did was it broke down the fund balance into two categories, what's called spendable and non-spendable. This is a beautiful thing because governmental decision makers, i.e. legislators and politicians, really don't know anything about accounting at all. And governmental accounting is kind of convoluted. So the question is usually going to be, do we have money to do this or not? So the GASB came up with is spendable versus non-spendable. Spendable fund balances is money you can still spend on stuff. Non-spendable fund balances are fund balances, as assets minus liabilities, fund balances that you've already committed to something. Either there's a law out there, there's a contract, there's something going on that money has been set aside for. Spendable means that it's still there and you could still use it to buy more stuff or spend on different things. And this segregation of the fund balance, remember, fund balance, net fund balance is assets minus liabilities under this scheme. So the fund balance, and in a regular company, right, it'd be stockholders' equity. So you would have common stock, paid-in capital, things like that. Non-spendable has been committed, spendable has not. And the nice thing about this approach is it really helps politicians understand what's going on. The question that the legislators are going to come up with is, how much money do we have? And they need to make a decision whether they can afford to buy something or not. If they can't afford it, it means they have to raise money or borrow money. To borrow money or somehow get money to pay for it. And in this situation, you could just show them the spendable fund balance, and that's what's available. So the names of the balance sheet, in the balance sheet, the way these general ledger accounts would work is you'd have spendable versus non-spendable, and spendable will have four categories, what's called restricted, limited, assigned, and unassigned. And really it's assigned, unassigned rather, that's what you can spend. Proprietary and fiduciary type funds have a different purpose, in that proprietary funds, mostly enterprise funds, have revenues and expenditures, and they can be run like businesses. So they'll have restricted and unrestricted. So this is what a balance sheet would look like for a governmental fund. You'd have assets and liabilities, and then you'd have fund balances that are non-spendable and spendable with these four categories. And then you have the P&L. Now, they don't call it a P&L because they don't have profits and they don't have losses. But it's So they call it the Statement of Revenues, Expenditures, and Changes in Fund Balance for Governmental Funds. And the nickname is lately the operating statement. But I think most accountants really call it the P&L, even though it's not a P&L. So the major sections here would be what's called the operating section. And I'll show you an example in a second, where you have revenues minus expenditures. You have other financing sources and uses. This is something a lot of students miss on quizzes. So a funding source would be bond issue proceeds. A funding use would be transfers into other funds. What's called special and extraordinary items. We're not going to do so much on that. And then you'd show how the fund balance changed. Because remember, fund balance is like stockholders' equity. So normally income would increase retained earnings, right? A loss would decrease it. So if you have an excess of revenues over expenditures and other financing sources over uses, we'll just call it an excess. If you have an excess, that will increase the fund balance. And if you have a negative excess, or what we call a decrease, then that would decrease the fund balance. So here you can see an example where you have revenues minus expenditures equals the excess, plus or minus other financing sources, plus sources minus uses, and special items, extraordinary items would give you your net change. And then you would add that to your beginning fund balance and get your ending fund balance.